Hello everyone, I'm Astha Khurana and welcome to Zerodha Varsity videos. Today we are kickstarting a new video series where we will talk about Warren Buffett, Berkshire Hathaway and his letters to his shareholder. For this series, I have two of my teammates from Varsity, Vineet and Satya. So Vineet is someone who loves to read, and that is when he took this Herculean task of reading all of Warren Buffett's letters. And I thought, why not pick his brain and actually ask for some insights where I and Satya both can learn and you as Varsity viewer can learn as well. Along with that, I have Satya, who's as inquisitive as I am, and both of us are actually planning to take this crash course on Warren Buffett's letter, which will help you as well. So in this very first episode, we will start from the year 1977 and talk till 1981. With every successive episode, we will cover a set of 5 letters each. So let's begin. Okay, so Vineet, actually you took on a very massive task, so I have to ask, what motivated you to read these letters?
Well, I like reading and I'm a finance professional. Anyone in this profession considers Warren Buffett's letters to shareholders as Holy Bible. So I had to read it, and when you said that we have to do this kind of a discussion, I decided I should read his biography and also cover his podcasts and some interviews as well. So yes, I did all of that. I'll try to be as accurate as possible. Any slippage here and there, dear Warren Buffett sir, if you're watching this, is completely inadvertent. Thank you so much for educating your shareholders and the public at large. May God bless you with a healthy, prolonged life. And we also have in our respect and prayers your partner, Charlie Munger, who left for the heavenly abode late in 2023. May his soul rest in peace.
I'm already excited about how much we're going to learn from these videos. But Vineet, Satya also reads a lot about Warren Buffett. So Satya, I want to ask from you something about his childhood, because we all know that he started early, but I don't know why he yet regrets that he did start a little late. So what do you have to tell about his childhood?
So imagine a young boy who is always interested in numbers and want to become rich. So he's always a frugal in nature. Okay. When it comes to spending. He would think twice before spending money. He always thinks about what would the amount that he's spending would earn for him in future.
Yeah, so anytime he was spending 100, he was like, this is $1 million I'm foregoing a few decades later.
Oh my God, he already had this thought this young?
Yeah, and I think the brilliant thing is he understood the power of compounding pretty early in his life. Okay. He know every penny counts. So he goes and delivers newspapers in the morning, delivers beverages and gums, and he would also get refund for the recycled Coke bottles, because every penny counts. Yeah. And that's the brilliant thing, right? You should know the benefit of compounding. Yeah. And I also heard this story, he telling his friend that he want to become a millionaire at the age of 30. Wow. Becoming a millionaire and at the age of 30 now feels or seems imaginable, but back in those days it doesn't, right? So this is one such story, and there's also one more story which is my favorite. He came across this book called 1,000 Ways to Earn $1,000. He came across this idea of buying a weighing machine. The weighing machine where you put in the coin and then check your weight.
Right.
Yeah. So he came across this idea of buying a weighing machine. He would sit and run tables on how long the profit from that weighing machine would take for him to buy another weighing machine.
I mean, this is so amazing that he's doing all this in his childhood, and let's face it, we as Gen Z and Millennial are not even thinking about investing, because we tell this to ourselves, this is so complicated, let's delay it to the point, or let us earn some amount of money and then we can do it. But I want to tell all the Gen Zs and Millennials, when they teach you in school time is money, this is what they actually mean.
He also started pretty early on in his life when it comes to investing. He started reading Ben Graham's books. He became the strong disciple of Ben Graham, who is considered the father of value investing. Right. So this is a bit about his background, but Vineet, I want to understand the dynamics between Warren Buffett and Charlie Munger. When did they meet? How did they work together? How did they analyze stocks?
Yeah.
So since you left at Ben Graham, let me begin there. Warren Buffett took Ben Graham's investing course at Columbia and then also started working for Ben Graham at his firm. When Ben Graham wanted to retire, he offered Warren to take over and run Ben's firm. Warren said, wait, if I can run it for you, I can run my own firm.
Right.
So he set up the Buffett partnership. And this Buffett partnership was clocking amazing returns for the time that it was existing. One of the investors introduced him to Charlie Munger, and they became the thickest of friends. Charlie was in LA running his own investment firm, and Warren in Omaha, his own Buffett partnership. Both of them would talk for hours at end and discuss notes, exchange notes about the securities that they wanted to invest in or the businesses that they would like to acquire. Through these discussions, that in 1965 they acquired Berkshire Hathaway. Warren was the majority shareholder and Charlie had a minority stake in it. Charlie had also acquired a few businesses where Warren was a minority shareholder. 10 years later, around 1975, is when they started consolidating everything under Berkshire Hathaway. And they continued to operate remotely, Charlie being in LA and Warren being in Omaha. And they said, we are just a phone call away.
Yeah, wow. Imagine them being on calls, talking about stocks for a long time.
I was imagining that now we're talking about work from home concept where teams are actually working from different locations, but they started this trend way back. And I mean, how wonderfully they have managed Berkshire Hathaway. But Vineet, I actually took on one point where you said that they acquired Berkshire Hathaway. I thought that Berkshire Hathaway was Warren Buffett's child. What do you mean they acquired it?
Well, Berkshire Hathaway was at least 100 years old when Warren Buffett acquired it in 1965, and it was in fact a textile company. So Warren Buffett started writing these letters right from 1965, but they were mostly transactional and reporting in nature. It was in 1977 when he started using a narrative approach and using these letters to educate his shareholders.
That is so amazing. So Vineet, coming back to the letters now, what I want to understand is that from 1977 to 81, what did the economic era look like at that time?
Well, around 1977, the inflation was very high, around 15-16%, and interest rates had also gone up. The US debt kept ballooning, and in order to pay that debt, they kept printing more and more dollars, further fueling inflation. And this was also the time when technology had not picked up as a trend. So consumer businesses or heavy businesses, utility businesses were still the in thing when you were investing in equities.
Right.
Talking about that printing money and inflation, we could draw parallels to what happened during the COVID times, right? Economies were in doldrums and the central banks across the world, they printed money, they reduced the interest rates, and what we've seen 2 years later is the rise in inflation, especially in the US where the printing money was rampant. We've seen the inflation touched 40-year high. But Vineet, with a lot of US dollars in supply, I wonder why USD doesn't devalue.
Well, experts have been calling for the collapse of the USD now. Warren Buffett called it out back in 1977. With so much printing, let's say if any other country were to print so much currency, they would go in a spiral of hyperinflation and their currency would depreciate. But this is the USD, which is a reserve currency, and all countries want to hoard it. So the more they supply, the more they print, the more other countries keep hoarding it. Which is why 45 years down the line, the USD is still standing strong where other currencies have depreciated.
Because the demand for USD keeps increasing and that is why it doesn't devalue at all.
True.
But I wonder how long it continues.
Right. Vineet, I'm holding on to one thought when we were talking about inflation and high interest rates. So generally, in the economic situation like that, debt instruments are something which look attractive. So I want to understand that what was Warren Buffett's view on this?
Well, at the time, the debt instruments were attractive. In 1977, a USD tax-free bond would give you 16% tax-free rate.
Right.
So the investors were shifting towards debt investments. Whereas in equity, let's say even if a good equity investment were to yield 20%, post-taxes you'll be left with just 14%. Mind you, inflation was around 15-16%. So equity was going to leave you poorer because of the inflation. Still, Warren Buffett held on to equities. He said inflation, like commonly it is understood that inflation is going to be better for businesses. He does not believe that. With inflation, the input costs will also go up. And if the business does not have pricing power, they may not be able to pass it down to their consumers. Still, for an investor, overall, he believes that in the long run, it is equities that help them improve and maintain their purchasing power.
Oh, this reminds me of how Buffett explains purchasing power during the inflationary periods. Asta, say you have $100.
I feel richer already.
Say you can buy 10 hamburgers today, but you forgo that option and you invested that amount. What would you expect? You would expect that you would earn some money on that and you would be able to buy more hamburgers in future. Say 5 years down the line, your investment would become $120. You would expect to buy more hamburgers.
Correct.
But go to the market, you would still get only 10 hamburgers.
You may feel richer, but you're not eating richer.
I get it.
So there's an important personal finance lesson that we all can take from this. Especially during the inflationary periods, we have to make sure that our income grows at a rate that is higher than the inflation. And if it doesn't, at least we have to make sure that we are saving more to retain our purchasing power.
After the example, it makes more sense.
It does.
So Vineet, I really wanted to ask this question in the very beginning, but better late than never. So I wanted to know in what companies and what sectors Warren Buffett was invested and why.
Sure. Berkshire's investments were of two types. One were the businesses that they wholly owned, and others were minority stakes in publicly listed companies. So the sectors were textiles, insurance, retail, trading stamps, media, and banking.
Okay.
Let me take you through each of these in a gist. First of all, textiles, which was Berkshire Hathaway's in-house business, and the profits that came out of this business were channeled into insurance and subsequently into other businesses. So then they had insurance. Within insurance, they had National Indemnity and several other state-level property and casualty insurers. They also owned about 33 to 35% in Geico. Warren kept saying in his letters to the shareholders that Geico was a better run business than his own insurance operations. Okay. But it didn't matter to him whether he owned the business or had just a minority stake in it, as long as he was on the ride.
Yeah,
that's nice.
Then there was trading stamps. This is like the loyalty reward points that we have on our credit cards. Back in the day, when you shopped at, let's say, a departmental store, in exchange for the change, they would give you these trading stamps. Once you had collected a lot of these stamps, you could trade them back to buy, let's say, a juicer or a tape recorder. There were no discounts at the time, so people would use these trading stamps to get something, let's say, for free. But this business eventually started declining because credit cards started maintaining loyalty points digitally, and businesses had started offering discounts. So this business was merged into Berkshire Hathaway and eventually shut down. Then there was banking. Berkshire Hathaway was invested in Rockford Bank, which was a local bank which had very stable ratios. Berkshire Hathaway had to exit it because they were an insurance company primarily, and the regulation required them to exit the banking business. Okay. Then there is retail, that is the C's Candies. It was experiential retail where the kids would go and buy candies. It had a very strong pricing power and was run by a very strong, efficient management as well, which is why Warren had invested in it. And lastly, there is media, where they owned the Buffalo News and 12% stake in Washington Post. He believed that media businesses had an amazing pricing power through selling their ads, which is why he invested in them. And we'll discuss media a bit more in the next video.
Okay, this is very interesting, the amount of investments that he has made. But what I want to understand is, Vineet, was he bullish really on all these sectors?
Well, bullish while buying them, but of course these sectors had their own problems. For example, the textile business, where the manufacturing was moving towards, let's say, the southern parts of US and also towards Asian countries where the labor was cheap. So in fact, textile had become a problem child for them.
Oh, really?
In fact, Warren adopted a problem child.
Wait, you were saying that it was a problem child. You were saying it was an adopted problem child. Where are we going wrong?
So Berkshire Hathaway, the textile business, was earlier run by Stanton family.
Okay.
Even in the beginning, it was not a very strong business. It always had its own problems. It's a textile industry. It's a very competitive industry. As you said, the labor cost was cheap in other countries, and it was always difficult to run this business, and sometimes with political intervention. So Warren, in 1962, he discovered that the book value of this company is higher than the market value.
Okay.
He started buying these shares at $7.5 per share. And he always wanted to sell these shares. He never wanted to hold these shares for a long time. once he met the promoters of the company, they had a handshake agreement that Warren would sell their shares at $11.5 per share.
Okay.
A few weeks later, when the tender offer came from the promoters, it was 12.5 cents lower per share. And that's it. Warren became so furious about it. He was not expecting this, and instead of selling the shares, he wants to buy the company.
I mean, not that he was not going to make profit from that deal, but yes, 12.5 cents lower per share.
Yes, all in a fit of rage because he thought that the Stantons had acted in bad faith.
Oh.
Even when he was acquiring, he knew it's a troublemaking company. And he didn't want to liquidate it even then because he knew he had to lay off a lot of workforce, and he wants to maintain that reputation. So he knew it's a troublemaking company.
Yes, it was a troublemaking business. So whatever small profits that the textiles was throwing up, Warren used it to buy insurance businesses and other businesses through that. But insurance had its own set of problems. For example, let's say Berkshire Hathaway had auto insurance business and healthcare insurance business. The inflation in auto repairs or healthcare was 9%, while at the same time the premiums were growing at just 3%. So your revenues are growing at 3% while your costs are growing at 9%. Warren could see and was warning his shareholders that margins in insurance business over the next few years are going to shrink. Moreover, he also pointed out another problem with the industry. Now, inflation was rampant. So these auto insurers said that we cannot predict the cost of auto repairs 1 year down the line. So they started selling insurance for just 6 months. Okay. The problem here was that they were selling it for 6 months and investing these premiums in 30-year bonds. Now, these are liabilities, although contingent, that could come calling in the next 6 months.
Right.
If they could come calling, this money is locked up in an asset that's for 30 years.
Crazy.
Now, this is a classic case of asset liability mismatch.
Yeah, this highlights how important asset liability management is for a banking or insurance company, right? Not just in India, globally. Maybe in the Indian context, we would have seen, what happened with the NBFC crisis, the DHFL and ILFS crisis. Of course, there are other reasons, but the main reason is asset liability mismatch that happened, even with S Bank.
Yeah, I mean, these small stories that we also have, the parallels that we draw to the Indian context, that they teach us that how, when you are doing sector analysis, these points are very important when you are investing into companies. And while we are on the sector analysis, there is one more question regarding to sector that I want to ask you, Vineet. That is, I have read that Warren and Charlie were not really fan of retail business, and yet they had See's Candies and they kept it in their portfolio. So I want to understand what was so special about this retail business.
Well, Warren loved Candies.
Okay.
But also that it was a very strongly run business. The management was very competent. And Warren brings up 3 aspects when you're looking at a retail business: revenue growth, volume growth, and same-store sales growth. Okay. Let me explain it to you with an example. Here we have volumes and here we have revenues. Let's say your volumes have grown 10%. And your revenues have also grown 10%, meaning you were able to sell more in quantity at the same price. Okay. But let's say if your volumes have grown 10% and your revenues have grown only 5%, meaning you were able to sell more at lower price, meaning you had to offer discounts to be able to sell more quantity. Okay. Again, let's say your volumes are 10% and your revenues have grown 20%, meaning you could sell more in quantity at higher price, meaning you are enjoying a very strong pricing power.
So here it's talking about the incremental capital that you are putting in establishing the new stores that is giving lower revenue.
And also that the older stores are declining because they're selling lesser in volumes. But See's Candies enjoyed a strong pricing power, which is why Warren and Charlie invested in it.
So for a retail business, the revenue, the sales, the same store sales all have to grow in tandem for the business to be more profitable.
Yes. Now, See's Candies enjoyed very strong pricing power.
So Vineet, let's try and generalize these sectors and help me understand what were a few key parameters, or let's call filters, that Warren had while he would choose on what business to invest.
Sure. Warren and Charlie had about 4 filters, and Warren kept talking about them in every letter. There were 4. The first it has to be a simple business, a business that they understood. They did not understand technology. They did not want to invest in technology. The business had to have good earnings prospects. It should be run by a strong management, strong and competent management. And the fourth, which was a deal maker or deal breaker, which was it had to be at an attractive price.
That is why Charlie Munger rightly said when he said a great business at fair price is superior to a fair business at great price.
So that's a great quote, and we have to be very careful about assessing the fair price. I want to bring up the Ben Graham's quote that Warren repeats in most of his letters. You would have read it multiple number of times. That imagine you sitting in a house and say a person called Mr. Market comes to your house every day buying and selling shares.
Okay.
On the days that Mr. Market is very happy, he would offer to buy or sell shares at very high prices. On days that Mr. Market is not in a good mood, he would offer to buy or sell shares at a very low prices. What we have to remember is that this Mr. Market is there to serve us, not to guide us. We should never get influenced by what Mr. Market is offering us. This is the lens through which Warren Buffett wants us to see the market.
That is actually really, really nicely put. But we need holding on to the thought where you talked about those four filters that Warren Buffett had. One filter that I want to talk to you about is, other three I could understood. But what do you mean when you said earning prospects? What does Warren has to say about earning prospects?
Warren and Charlie always looked at the intrinsic value of a business. Now, since it wasn't very easy to identify the intrinsic value, they would look at the book value, which was the closest proxy for intrinsic value. Let's try to understand both. Let's say there's a family that has two kids. They are spending equal amounts on both kids' education. This is the book value of the kids. The amount of money that these kids will earn through their lifetimes is their intrinsic value. So in a business, what you've put so far is your book value. What you will earn in the future is your intrinsic value.
Wow, right. Nicely explained.
And because we're talking about earnings growth, people commonly look at the net profit growth. Warren Buffett is saying, let's say your capital from last year has grown 20%, but your earnings have grown only 10%. It means the newer capital gave you smaller profits. So you should actually be looking at ROE. If your capital has grown 20%, your earnings should also grow at 20 or more, so that you maintain or improve your earnings. And then there's a third point that I would like to bring up. That's about the consolidated statements and standalone statements. In our investment world, we commonly look at consolidated statements.
Yes, we do.
But Warren is saying, if it's a holding company like Berkshire Hathaway, you should be looking at the standalone financials of all the subsidiaries. This is because as a holding company, it has a diverse set of businesses. So the consolidated number gives you a total, but not the clear picture of how the business is. However, this is not applicable to, let's say, a conglomerate. In India's example, it would be, let's say, Reliance Industries, which is a conglomerate and has about 300 subsidiaries and associate companies. You cannot practically be looking at all the 300 companies, which is why you should be looking at the consolidated statements in case of Reliance. And this is also why analysts would generally apply a conglomerate discount when they are analyzing a conglomerate, because there are so many companies held under a conglomerate. But if it's a holding company, in India's context, let's say Bajaj Holdings, if you're analyzing Bajaj Holdings, you should be looking at all the companies that are held under Bajaj Holdings and not just the consolidated number of Bajaj Holdings. So see, Satya, he's bringing this up because he wants his shareholders to read Berkshire's financials that way. He wants them to not look at the consolidated numbers, but at the standalone numbers, because he and Charlie prefer to look at it that way.
A short-term investor who wants to gain from the fluctuations in the market cannot put so much effort, right? It's only the long-term investor with a lot of patience can go through all these subsidiaries, details and the business prospects.
So for Warren and Charlie, their investment holding period was forever. They were forever investors.
Let me call them, or maybe like the Warren Buffett style investing, where he would hold on to a company for a longer time period and he would only leave them if there was an operational problem with the particular company or business and not otherwise. So let's call those investors like forever investors.
I really love how he writes his letters, right? It's very, very informational and very simple and straightforward, but yet connects to all of us. That's brilliant. And I also love how transparent they are when they are writing these letters. letters, because Buffett and Munger, they go through a lot of annual reports on a daily basis, not even a weekly or yearly basis. They know what shareholders expect, and he keeps saying that he want to write the shareholders letters in a way to provide information that he would want to know as a shareholder.
In fact, he used these letters to set the expectations straight for his shareholders. Berkshire Hathaway was averaging about 23 to 24% earnings every year, and Warren is warning them that expect this average to come down to 15% in the long run.
Okay. I mean, I like how Warren is conservative in terms of setting his expectation. He understands the fact that if you overcommit and don't deliver, that is when the problem comes. But if you are conservative in terms of expectation, and if you are able to over-deliver, then people are more happy. And that is why we keep repeating to retail investors that behavioral finance is very, very important. If you can't control your emotions, if you can't set your expectations right, then even though you are doing good with managing your money, but those wrong expectations can actually affect you a lot. Okay, so now we've reached the end of our video, and before we wrap it up, why don't you summarize it one last time?
Sure. So this is 1977 to 81 when we are discussing. There was a general shift towards debt, but Warren was still heavyweight on equities. Berkshire was invested in textiles, insurance, retail, trading stamps, banking, and media. Then we also covered his investing filters, that is businesses that they understood with strong earnings prospects, with a competent management, and at an attractive price. And lastly, we learned about book value, intrinsic value, return on equity, and the use of consolidated versus standalone statements when it came to a holding company like Berkshire Hathaway.
Nice. That was a nice quick summary.
But Astha and Satya, you said that this was a crash course for you. So why don't you give your key takeaways?
My first key takeaway is maybe how to be appreciative of the compounding benefit. He learned about the benefit of compounding at an early age, and that every penny counts. So I want to be more mindful before I spend money in future, thinking about the compounding benefit. The second one would be maybe how he thinks about investing in the inflationary period, especially that he stuck to equity investing even during the inflationary periods when equities were not doing well. But he believed that in the long run, equities are the only instruments that could beat inflation. So that's my key second takeaway. The third one would be, what else? How he's a long-term investor. Yeah. He's 93 and he still invests for long-term. Right. And how to set expectations right. Yes. That's very, very important, as you also mentioned. In the age where there are so many screenshots, people claiming that they are earning double-digit returns, triple-digit returns sometimes, it is very important to stay the investing journey with the right set of expectations. So those are my three key takeaways.
Nice, Satya. Now that you've talked more about the qualitative aspect of the video that we have learned, let me bring out some quantitative aspects that I have learned as my key takeaways. The first one I want to mention about is one of his accounting principles that he talked about was book value and intrinsic value. So, I like the way how he has explained that what you've put so far in the business is your book value, and what you will be earning in the future is your intrinsic value. We were talking about problems in insurance and how asset liability mismanagement is a problem, and management is something that we need to look after. And if any retail investor is doing sectoral analysis, so these are the key parameters that you should focus on before you're investing. And talking about sectors, the third key takeaway that I like is when he was explaining the retail sector, where he mentioned about 3 points. I mean, of course, there are other points. The 3 points that we learned from these letters were the volume growth, the sales growth, and same store sales growth. So these are my key takeaways. So I would want to ask you, what were your key takeaways? Do mention us in the comment section. So this was all about the first episode where we talked about from the era of 1977 to 1981. In the next episode, we will be taking up what we need promise, what happened in media, and we will talk about the letters from the year 1982 to 1986. Stay tuned. Happy investing.